If the stock market is at an all-time high, should you really be investing new money in the stock market? Well, some people think that when the stock market's at an all-time high, that creates some sort of ceiling, an impending crash is coming, something like that. I can understand why some people would think that, but let's jump into the data to see what has happened in the past when the stock market has been at an all-time high. Looking at the stock market data for the S&P 500 going back to 1926 all the way up to most recently in 2022, Dimensional Fund Advisors did this research study that took a look at the returns at the end of every month during that period of time. So there's over 1,000 different periods of time that they looked at to see whether the stock market was at an all-time high or not, and then what were the returns after that period of time. Between 1926 and 2022, 30% of all months ended at all-time highs. That's way more than I actually thought. But it also makes sense because stocks do have an expected positive return, and so seeing many all-time highs or very frequent all-time highs, that also makes sense too. But let's take a look and see what returns have been after the market has been at an all-time high. So if you invested your money at the S&P 500's all-time high anytime over the last virtually 100 years, 1 year later, your average return would be 13.7%. Now, the data that's showing here isn't an actual investment itself, it's just the index, and you can't invest directly in the index even with an index fund, but it's close enough to kind of illustrate the point here. So 1 year later, you're looking pretty good. 3 years later and 5 years later, you're actually in a very similar situation where your average annualized return is over 10% per year. This is again looking back, and going forward, who knows what could possibly happen, but on average, looking backwards, the returns have been very positive even when investing at all-time highs. Now, if you look at the red bars in the graph there, this shows the average annualized compound returns after months that ended at any level. So this includes the all-time highs, but also every other one in the data set as well. So 1 year later, it's pretty similar, but a little bit lower at 12.4%. And then 3 years later and 5 years later, almost exactly the same as if you invested at all-time highs. It's not shown on the graph there, but the same research showed that 81% of the time, the S&P 500 had been positive 1 year later, and 86% of the time, 5 years later. So it's not just a huge amount of positive returns in 1 year and a bunch of negatives. The number of times that it happens is actually quite high too. It's better than a coin toss. So over 80% of the time, if you're looking at 1 year or 5 years, historically speaking, the markets have been positive even after being at all-time highs. So if you're trying to invest in an evidence-based way as opposed to gut feeling or hunches or anything like that, if you're looking at what the data say, it would not make sense to wait until a hypothetical crash or a big downturn in the market happens before investing new money. If you're still particularly nervous about something like that, doing something called dollar cost averaging could be an effective strategy. Again, the math doesn't really add up in terms of how often it works out in your favor, but it does take some of the psychological pressure off of getting the timing potentially wrong if a market decline does happen soon after you make an investment. Especially for people who are new to investing, the psychological component is real. It's not something that can just be completely ignored because we're humans. We're not pieces of data, we're not robots. Investing takes emotion, and sometimes it's really hard to actually get emotion out of the picture. And so if you are very, very nervous about it, the data doesn't support it, but you could ease your way into the market and buy at smaller intervals along the way instead of putting everything in all at once. If you're asking me, in my opinion, what I would do, using history as our guide, I would say putting the money into the market sooner than later gives you the most odds of success of getting a positive rate of return in the future. Thanks so much for watching. We'll see you in another video.